So today's Cardinal lesson, we're talking about the most important subject that we deal with in the 7 worries, and that's long-term care. And what I want to talk about is we're going to go over a lot of facts, figures, insurance, that type of thing, and we're going to try to enlighten you and teach you about the different types of long-term care policies or life insurance policies that can protect you for long-term care. But we'd just be remiss if we didn't talk about why are we doing this. I mean, a lot of our videos talk about that. And what I just want to emphasize is that if you in the future need long-term care, either at home or in an assisted living or a nursing home, and for a period of time, and the consequences are going to be devastating to your family. They just are. I mean, families that go through this, they have a lot of difficulties. And they're going to be especially troublesome if you don't have a plan for what they're going to do, what your family's going to do. Because this isn't going to be you doing it. It's what your family's going to do and how they're going to pay for this stuff if you need it for several years. Okay? So we're going to get into some of the facts and figures and insurance and solutions that we have at our disposal here at Cardinal to help you. But before we do that, I just wanted you to get clear on why we're talking about this today. So I want to bring Tom on, and I want Tom to talk a little bit about the grid that you see up here on the board.
Yeah, and so I think Hans is exactly right. I mean, this is important. This is where we make the biggest impact on our clients' lives is when we help them with this. What we have on the board is really a spectrum of different types of policies. If you're looking at the board on the far left is traditional long-term care insurance, and the further right we go, the more it looks more and more like life insurance. And so to the extreme on the far right, it's primarily life insurance with maybe a little bit of long-term care benefits. So what we want to do, I'm going to bring up the show notes here. We're not going to go through every page of the show notes. It's pretty detailed. We're not going to hit all these boxes in real detail in the show either. So if you want more information, more detail here, pull up the show notes. You can find this at the link of the video below or on our website. But this gives you a lot of really good information. But it goes through and it really breaks out sort of the differences between these types of policies and how they differ, how they're similar, and just really what you're looking for. So we'll get back to the board. We'll really talk more about this in detail. I don't need you to look at it right now, but just know that you can go get more information on these show notes on your own time if you want.
Okay. So if you look at the board here, over here on the left is long-term care or pure traditional long-term care insurance. And over on the right is pretty much pure life insurance. And everything in the middle is, to an extent, a combination of the two. So, when you think about this, we probably have 100 different solutions for long-term care. And understand, we're not going to explain all 100 of them to you. We're going to talk to you for a while, and we're going to narrow it down to one of these solutions based upon your wishes, desires, and financial situation, how much money you can put into this, what your health situation is. There's a whole bunch of factors that enter into it. But this thing is, we're going over this just to show you the spectrum of insurance solutions that we have that you can use to protect yourself and your family. So over here to the left is traditional long-term care. And when I say, and I'm speaking to a group, or I'm discussing this with people in general, or clients coming in the door, and I mention long-term care, it's this column which people think about, which is a pure long-term care insurance policy. That's the only benefit. The only way you're going to collect anything out of the policy is if you get sick, okay? And you are needing care. So a pure long-term care insurance, it is the least expensive way to get started on a policy. I mean, with 1 month's premium or 2 months premium, you can get the policy started. $300, $400, $500 a month, and you're in. Or an annual basis, 4, 5, 6 grand, you're good to go. Now you're going to pay for this for life. I mean, you're going to pay a premium for the rest of your life, yeah, or until you're getting care. A lot of these policies have a waiver of premium on them so that once you're receiving care, you don't actually have to pay the premium. You also can get a premium increase. The insurance company can come to you years later and increase the premium. And like I said, the cost can go up. There is no death benefit on these policies. And so the death benefit is typically, um, something that if you don't use it, it, you just have a heart attack and pass away and you never used a day of care. I mean, nobody's going to get anything out of this policy. And that's a problem for some people. That's the kind of the way insurance works. But typically, all these other policies really deal with this issue. Um, this has the hardest health qualification, meaning that they're going to go through and ask you a bunch of questions. And if you've got a chronic illness or a couple of them, and they're fired up or they've reached a point where they're pretty severe, they're not going to offer this type of coverage to you. So it's the hardest health qualification. Putting inflation benefits on here is just easy. It's just a mathematical calculation and it just costs you money. But I listed that as easy. And there is no life insurance. Now that's kind of redundant with the no death benefit, but this is pure long-term care over here at the left end of the spectrum. And then going along the spectrum at the bottom, what I was just going to show you is the linked benefit. You're going to need of life insurance about 250,000 to get a substantial long-term care policy. So you'd buy a $250,000 policy, and then that policy would have extended benefits after you use up the 250 grand, of probably another 250,000. But just wanted to show everybody it takes about 250,000 of life insurance to make a substantial enough policy. When you get into this middle category, you're really going to need $500,000 worth of life insurance that's enforced for life to pay out a substantial long-term care benefit. And then as well, the chronic illness rider, the life insurance with a chronic illness rider, the same 500,000. And then this over life insurance with the no pay upfront chronic illness rider. You're going to need about $500,000. So I'm going to bring Tom back on, and I want Tom to talk about the spectrum here and to really talk a little bit about why we would use the different types of policies.
Yeah, and so I do want to make a point. So we've done a lot of videos on long-term care and several on hybrid policies that I don't want to get into the details of those, but the One America policy, we did a video on a Securian policy recently. That's that green column. So that's the one that a lot of our long-term care videos are on. That's probably what we sell the most of in our business because I think it mixes the two well. But it's not certainly it's not everything we sell. But that's if you're looking for what column that falls in, that's that linked benefit column. When we start looking across the spectrum, the further right we go, the less and less it starts looking like long-term care. Is if your primary purpose for planning is long-term care, you really want to be in the three most left columns. Anything to the right of that is really primarily life insurance. Life insurance needs to be the main focus of recommending those policies, and the long-term care aspect of it is just an added benefit. It's secondary. But we have a lot of people that come into us, they tell us they have a long-term care policy when really they have something on the right side of the board that really is not meant for that. That's not the primary purpose. And so I just want to, be knowledgeable about what you're purchasing and where it falls in there. Not saying there's anything wrong with the policies on the right side of the board. It's just that's not, if you're doing long-term care planning specifically, that's not where we would start with. But the reason we would use the different things are different options. I mean, one big difference between the two, the green and the blue one right in the middle of the board, is those ones are able to use IRA funds. Specifically, if you look at some of the annuity policies there, a lot of people, that's where their money is in IRAs, 401ks. And so we might use one of those two policies because those are the ones that can accept IRA money, whereas the other ones on the board aren't able to. So, I mean, there's lots of reasons we might use different ones. Most of them have some, I mean, they're on the board because they have some aspects of long-term care, but just know the three on the left are really what you want to look at if you're really wanting to plan for long-term care.
Well, in this one, and possibly this one, or where we're going to, we're going to use primarily a single premium. These are people that have $100,000 or a couple of $100,000 that they're going to dedicate to this purpose, and then they're not going to pay any more premiums. And then, and they can do that in an annuity policy or a life insurance policy. And then if they pass away without using it or using much of it, there's going to be a substantial death benefit there for their heirs. And that's a priority to them. They have the money, and there's tax benefits for putting their money into this. And, you kind of got to look at, why does the IRS, why does the federal government put tax incentives or bake tax benefits into long-term care insurance? And I'm going to answer my own question, is because this is for the general good, to have people protecting themselves against long-term care. So when they're collecting on these things, or their heirs are collecting the ultimate death benefit because they didn't use it much, that's going to all come on a tax-favored or tax-free basis to the people. So this is just to show the spectrum, and the places where we're going to use an annuity as opposed to life insurance is typically where somebody is got health problems, and the insurance company won't take them on a life insurance policy, but they will consider them with an annuity with some added long-term care benefits. So it's kind of that middle or gray area of people that have health conditions, but they're not so severe that nobody's going to take them on anything. So we can talk to you individually about that. So we have a whole spectrum, and these ones over here where we use this are the people that preferably they're looking at life insurance, and they want life insurance. They want a substantial amount of life insurance. Maybe they need life insurance, into retirement, so that their spouse or their remainder collects a substantial payment. And then the life insurance benefit is just an, oh, by the way, or excuse me, the long-term care benefit is just an, oh, by the way. And they're going to be real glad that they bought this if they end up needing it for long-term care.
I will say most permanent policies, most life insurance permanent policies, so not term, fall on that right side of the board. I mean, most of the modern policies, I guess I should say, if you're buying them today, not if you bought them years ago, but most of them have this chronic, at least this chronic illness rider built into the policy. It doesn't cost anything extra. It allows you some access to it. But again, it's really an afterthought. It's not the primary purpose of purchasing that type of policy.
Okay, so we want to go through how does this fit in our financial planning? Well, we talked today about taxes, and I actually got this presentation ready because I'm speaking to a group. Tom and I are speaking together to a large group of CPAs and attorneys, where we're really going to talk about the tax benefits. But that's what got me to get this grid out, and I decided I'm going to make a video for everybody. We talked about estate planning because there's a lot of folks who just don't want to invest in anything, or specifically invest in long-term care, because they just don't think they're ever going to need it, and it's just robbing from their ultimate estate. And so all these other types are a way to actually create an estate. And specifically, if you don't use the policy for long-term care, these create an income, and especially a high income, which is needed when you're receiving care. We talked about 401k and IRA, which is a big area of our practice. And we can use IRA and 401k money strategically to purchase this type of insurance. The whole video has been about long-term care, and protecting your family is really what you're doing against the consequences of not having a plan. Medicare just pays very little for long-term care, so let's just rule that out. And your Social Security check is the first place that your kids or your spouse is going to go for money, monthly money, to pay the bill for your long-term care. So it's effectively going to get all thrown at that if you need long-term care. So what I want to do is bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.